Someone can invest money every single month for 20 years and still end up with almost nothing to show for it. Not because the market crashed, not because they picked a bad stock, not because they were unlucky. They stayed poor while doing the one thing every finance book tells you to do, because the real obstacle was never information. It was never a missing formula or a secret fund only rich people know about. The real obstacle is something so ordinary that almost nobody notices it happening in real time, and by the time they do notice, decades have already passed. This is the story of why knowing what to do with money and actually keeping money working for you are two completely different skills, and why most people only ever learn one of them. Right now, more people have access to investing than at any point in history. Anyone with a phone can open a brokerage account in minutes and buy a piece of a global company before they finish their coffee. Financial information has never been more available either. Podcasts, videos, articles, and free calculators explain compound interest, diversification, and index funds in painless detail. By every historical measure, this should be the golden age of ordinary people building wealth. And yet, most people who start investing quietly stop, panic sell during downturns, or shrink their contributions the moment life gets uncomfortable. This is not a small side effect. Multiple long-term studies on investor behavior have found that individual investors consistently earn lower returns than the very funds they are invested in, simply because of when they buy and sell. In other words, the product performs fine. The person operating it does not. That gap between what the market returns and what the average investor actually keeps is sometimes called the behavior gap, and it is the quiet reason a huge number of people invest for years without building real wealth. This isn't a fringe statistic buried in an obscure academic paper either. It shows up consistently across different decades, different countries, and completely different market conditions, which is exactly what makes it so important to understand. It means the problem cannot be solved simply by choosing a better app, a cheaper fund, or a smarter advisor, because the gap follows the investor, not the investment. Think about how strange that actually is. In almost every other area of life, having better tools and more information produces better outcomes. A carpenter with sharper tools and a clearer blueprint builds a better structure. But money behaves differently because the tool itself is not the limiting factor. The person holding it is. Let's start with the foundational mechanics, because the mechanism behind this gap is simpler than it sounds. Investing only works because of time and consistency multiplying on top of each other. Imagine planting a tree. The first year, you barely see anything happen above the soil. The 500th year, that same tree could be enormous, but almost none of that size showed up in year one. Compound growth behaves the same way. Most of an investment's growth happens in the final years of holding it, not the first ones. This means the entire system is designed to reward people who do nothing dramatic for a very long time. The real technical workflow underneath this is straightforward. Money goes into an asset. That asset earns a return. The return gets added to the original amount, and next year's growth is calculated on that larger number. Small, boring, repeated additions on top of previous gains is the entire engine. There is no hidden trick here. The math is public and has been for centuries. To put a real shape on this, imagine two people who each invest the same amount of money, but one of them starts 10 years earlier than the other. Even if the late starter eventually contributes far more money in total, the early starter often ends up with significantly more at the end, purely because their money had more time cycles to compound on top of itself. This is why financial educators repeat the phrase, time the market beats timing the market. So often it almost becomes background noise, even though the underlying reason is rarely explained clearly. It isn't a motivational slogan. It's a direct description of how exponential growth physically works, and it means the single most expensive mistake in investing isn't picking the wrong asset. It's simply not staying invested long enough for the engine to build momentum. Now here is the invisible process that most people never see coming, because it isn't a math problem, it's a psychology problem. Markets do not move in a smooth, comfortable line. They drop, sometimes suddenly and sharply, and those drops are not rare glitches. They are a normal, recurring part of how markets have always behaved. A person who only reads about investing sees a chart that goes up over 30 years. A person who actually invests experiences that same chart one terrifying day at a time, watching their real savings shrink on a screen in front of them. This is where the behavior gap is actually created. When the value of an investment falls, the brain treats it almost like a physical threat, triggering the same stress response that would fire if something was chasing you. Selling in that moment feels like safety. It feels responsible. But selling during a downturn is often the single most expensive decision an investor can make, because it locks in a loss and removes any chance of participating in the recovery that historically follows. The invisible process here is not a hidden fee or a secret market manipulation. It is the ordinary human nervous system reacting exactly the way it is built to react at exactly the wrong moment for long-term wealth. This is worth sitting with for a moment, because it reframes the entire problem. People often assume they will simply know better when the moment comes, that they will remember the long-term chart and stay calm. But the fear response doesn't wait for permission from the logical part of the brain. It fires first, fast, and physically, which is why so many otherwise disciplined, intelligent people still find themselves clicking sell during a downturn despite fully understanding, in calmer moments, that it's usually the wrong move. Financial knowledge lives in one part of the brain. Panic lives somewhere else entirely, and under real pressure, panic tends to win the argument. Let's look at two real-world patterns that show this clearly. During the market crash tied to the 2008 financial crisis, a large portion of retirement account holders significantly reduced or completely paused their contributions right as prices were at their lowest, according to data later published by major retirement plan providers. The investors who kept contributing through that period, buying more shares while prices were depressed, were positioned to benefit the most once markets recovered in the following years. The second pattern shows up during the sharp, sudden market drop in early 2020. Trading platforms recorded enormous spikes in selling activity in the days the market fell fastest, right before a historic recovery began within the same year. In both cases, the underlying companies people had invested in were not destroyed. Their long-term earning power was largely intact. What changed was investor behavior during a moment of fear, and that behavioral choice, repeated across millions of people, is a major reason average investor returns lag behind the market itself over long stretches of time. There's a third pattern worth mentioning, one that shows up less dramatically but arguably does more cumulative damage over time. It's the slow, quiet reduction of contributions during ordinary financial stress, not a crisis, just an unusually tight month, a surprise expense, or a temporary pay cut. Someone lowers their automatic investment for just this 1 month, and that 1 month quietly becomes a habit. There's no dramatic headline attached to this pattern, no crash to point to, which is exactly why it does so much unnoticed damage. It never feels like the moment that mattered, so nobody remembers it as the turning point, even though the years of missed contributions compound in reverse, working against the very system that was supposed to build wealth. This leads directly into the biggest misconception people carry into investing, which is the belief that success is primarily about finding the right investment. Endless energy gets spent debating which fund, which stock, or which strategy is best, as if picking correctly is the hard part. In reality, a diversified, low-cost investment held with unusual patience will typically outperform a theoretically superior investment that gets abandoned during the first serious downturn. The friction point is not intelligence, and it is not access to information, because plenty of highly intelligent, well-informed people still sell at the worst possible time. The friction point is emotional endurance under uncertainty, sustained over years, without any guarantee of exactly when things will improve. That is an uncomfortable, unglamorous skill, and it doesn't get nearly as much attention as picking the next big stock, even though it matters far more to the final outcome. Zoom out, and this pattern is not unique to individual investors. It shows up everywhere humans try to build something valuable over long stretches of time. Companies abandon promising long-term strategies because quarterly results look weak. Governments reverse long-term policy the moment short-term public opinion shifts. Entire industries are shaped by the same core tension, the pull of an uncomfortable present against the reward of a patient future. As access to investing continues to expand globally, and as more first-time investors enter markets through mobile apps that make buying and selling frictionless within seconds, this behavior gap is likely to become even more influential, not less. The same technology that made investing accessible to almost everyone also makes panic selling accessible to almost everyone in the exact same number of taps. So if there's one idea worth carrying away from all of this, it's this. The biggest risk to your wealth was never the market itself. It was the moment you were tempted to react to it. The tree in the story doesn't grow because someone found a secret fertilizer. It grows because nobody dug it up during the years it looked like nothing was happening. 90% of people who invest still stay poor, not because the system failed them, but because they left before the system had time to work. The real edge in investing was never a hidden formula. It was patience applied for longer than felt comfortable.